The US stock market ended last Friday on a weaker footing, where all four major US stock indices declined by close to negative 0.3% to negative 0.6% and ended with a third consecutive weekly losses due to this ongoing US-Iran conflict that is showing no signs of de-escalation. And as we kickstart today's Asia session, it has entered into this 17th day with a rather mixed headline, mixed headline coming out over the weekend, where there was some reports stating that there is potentially ongoing talks between US and Iran to potentially put a halt to this conflict as being indicated by US President Donald Trump. But on the other hand, from the Iranians' point of view, there has been a continuation of reiteration that there is no ongoing negotiation between US and Iran. And over last Friday, US forces bombed military assets in a key Iranian energy export hub, kickstarting a yo-yo session in the oil price in today's early Asia session, where pardon me, where oil prices rose by almost 1%. And as we are speaking right now, the gains has been slowly been trended downwards to only 0.2%. However, it doesn't really create a positive feedback loop into the entire Asia Pacific stock market as we are speaking right now. Mixed performance, where we start to see a bit of potential gains that is being reflected on the Hong Kong stock indices due to a better than expected key economic data coming out from China, which is industrial production and retail sales that managed to beat expectation. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Before we kickstart today's gist of the Daily Dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a recap of what has taken shape on last Friday over the weekend and early today's Asia session. So let's start on last Friday first, more pertaining to the news flow surrounding this ongoing US-Iran war/conflict over here. All right, so let me share you guys. Yes, this is the ongoing conflict. All right, so 1 second. Yes, so this is the what has taken shape over the weekend on Friday. So Brent crude rose on last Friday following earlier US strike on Iran's Khan Island. So basically, this Khan Island is the export energy hub of Iran, where they export their oil to the rest of the world. So what US now wants to do is to take out Iranians' key jewel, which is their oil exports over here. So by taking out their oil exports, potentially it could lead to very severe economic downfall in the Iranian economy. And with that, Iranian is rather a hard line, stating that they do not want to back down, despite Trump claiming that there's some ongoing negotiation that may take place in the near future. Then in early this morning, Iranian attacks continues to strike surrounding Gulf states, like the Dubai International Airport has been temporarily suspended after a drone incident caused a fuel tank to actually catch fire. And right now, based on the latest news flow, US President Trump says that he's demanding other countries to help secure passage through the Strait of Hormuz over here. So what he's saying that he wants other countries to actually take part in this ongoing conflict with the US and Iranians, we call it relationship that is not turning around pretty soon. Due to this surprise, not a surprise, but in a way that there's this both sides are actually exchanging rhetoric attacks on one another, and apparently they're trying to play a hardball game. That means, i.e., the Iranians trying to cause economic damage to US and her allies, particularly Israel, by choking off global energy flows coming through the Strait of Hormuz over here. And at that point in time, also trying to attack the Gulf states itself, because the Gulf states also has significant energy supply to the rest of the world. And given the fact that it also houses the OPEC plus cartel members in the Gulf states. So by attacking the Gulf states over here, they would actually pressure the Gulf states to put pressure on US side to stop this attack on Iran. Do not forget over here is that the Gulf states are also pretty much dependent on oil flows to run their economy. And we know that in the last 3 to 4 years that they have been trying to transit into a oil producing country to a tourism consumer based country. But however, if this attacks continues to does not de-escalate, and Iran continues to do what I call a revenge attack on the Gulf states, targeting key countries that right now has transited into a tourism slash consumer based economy like Saudi Arabia and as well as UAE, Dubai, that could also potentially chalk off this Gulf states economic growth. So net overall, by doing this, Iran hopes to put pressure on US and her allies in terms of asking them to back down due to economic sabotage. But however, both sides are not showing signs of backing down, and that causes oil prices to go up. And if oil prices continues to remain firm on a medium-term perspective, that could potentially see stagflation risk coming into the picture, not even in US, and being impacted against the rest of the world over here. All right. So over in what we could see over here is that due to this ongoing surge in oil price, we now start to see the liquidity drain or potential liquidity squeeze that could play out in the US economy due to a potentially less dovish Fed. So what we could see is that based on the CME Fed Watch 2, the latest data that we have, for sure the next this coming week, Wednesday 18 March meeting, that means Singapore time will be 2 a.m. 19 March on the Thursday, will be almost 100% unchanged. So the Fed will stand pat to maintain it at 3.5% to 3.75%, 3.5% to 3.75% for the Fed funds rate. And if you look down the calendar, also rather high odds that in the coming months of April, June, July is now like a coin. July now is like a coin flip. 50%, 52%, no change. 48% market is expecting a cut. So previously in July, the odds was rather high. In the about 5 days ago, there was a hovering still about 60%, where the Fed funds futures traders are expecting the Fed to do the fourth interest rate cut, which is the first cut for this year. Fourth will be the ongoing interest rate cut cycle, where the Fed cut 3 times late last year to bring it down to 3.25% to 3.5%. So if you look at the higher odds of the fourth cut for this ongoing interest rate cut cycle by the US Federal Reserve, will only come in on the October meeting. So that will be, I would say that will be the Q4 of this year. So it's being pushed down the calendar. So 64% market is expecting a 25 basis point cut on the 28th of October 2026 FOMC meeting to bring it down to 3.25% to 3.5%. And thereafter, there will be no cut, because if you look at this by the last meeting of this year, which is on the 9th of December 2026 FOMC meeting, 97% chance the market is expecting the Fed funds rate to be at 3.25% to 3.5%. So that only implies one interest rate cut this year. So that has been reduced from 2 potential interest rate cut being penciled in at the start of this year before this ongoing US-Iran conflict / war. So what we could see now is that the interest rate cut expectation as portrayed by Fed funds futures trader has been reduced, and they also push down the next potential interest rate cut down the calendar, further down the calendar ahead. So that is actually a potential liquidity squeeze scenario that could take shape in the US economy, which is also negatively which also has a negative impact on risk appetite. That means creating this ongoing risk-off scenario in majority of the global stock market as we are speaking right now. And given the fact that the tightening liquidity, potential tightening liquidity in the so-called the US economy as being portrayed by the price action of the Fed funds futures traders, calculated by the CME Fed Watch tool, that also created a push up in the US dollar index as well. So the US dollar index, what it did last week, it also gained pretty much strongly. And if you look at the gain of the US dollar index over here, it has shoot up to retest the key medium-term range top or range resistance that has been in place since 29th of May 2025 last year, where it hit this 100.54 level and start trading in this kind of sideways complex range. And right now is last Friday price action actually rallied straight up to this 100.53, 100.5 key upper limit of this medium-term range resistance level. Right, and today Asia session, there's some form of profit taking coming play in the US dollar index over here. So the US dollar index is down by negative 0.2% as we're speaking right now. Some profit taking or unwinding of last Friday net long US dollar position by short-term speculators. So one of the reasons why the dollar is falling right now as we are speaking at 11:13 a.m. Singapore time is due to some US-China trade talks optimism. So we know that US President Trump will be visiting China at the end of this month, and he will have a one-to-one dialogue with China presidency. So most of this dialogue will center on this ongoing trade talks negotiation, where both sides has still tariffs being ignited on both exports and imports. And there is some positive, we call it a news flow coming out from this talks done by their trade negotiation officers from both sides. So yesterday was the first round of talks that's been kickstarted between the US Treasury Scott Bessent, which is leading the trade negotiation team from US, and they had a talk with his China counterparts over in Europe yesterday over here. So I think it should be Spain, if I'm not wrong, but it's in one of the city in Europe. So this talk is kind of what I call it, filling up the loose ends before US President Trump visit China at the end of this month. So based on sources as reported by CNBC, stating that both sides discuss farm goods managed trade in a remarkable stable. Okay, it's Paris, not Spain. Sorry, they actually they are in Spain right now. And yesterday was the first round of this talk, trade negotiation talk, and today will be the second round over here. All right. So give me a minute. Let me highlight it in. Okay, so hopefully it's large enough. All right. So the sources told Reuters that the first session of this two-day negotiation talks from both sides were candid and constructive, and US were being led by US Treasury Secretary Scott Bessent, and the China delegate is being led by Chinese Vice Premier He Lifeng. So this will be what I call that some groundwork, or we call it possible deliverables for Trump trips to China to meet with China presidency at the end of March. But they added that at the end of the day, both leaders will have a final say on the proposals. All right. So because due of this rather lukewarm positive outcome of the first day of negotiation talk between US and Chinese official, that created a dollar mini setback as we are speaking right now, where the US dollar index is down by negative 0.24%. And over in Asia, over here, we also start to see a bit of mixed performance in the Asia Pacific stock indices as we are speaking right now. So let me take you through. Going up, all right. So even the S&P E-mini futures and the Dow Jones E-mini futures are staging intraday gain right now as we are speaking, up by 0.4% each, all right, and trading closed the session high at the start of today's Asia session, all right, for both the S&P E-mini and the Nasdaq 100 E-mini futures. So it's likely also due to that positive news flow coming from yesterday's day one of the US China trade officials negotiation talk. And over in Asia, over here is rather mixed bag. So what we see over here is that the Nikkei 225 is down by negative 1.3%, trading at the session low right now. The Nikkei 225 futures, taking into account of last Friday US session price action, is almost unchanged, also trading near the session low. But however, interestingly, the Hong Kong benchmark stock indices, which is the Hang Seng Index, the Hang Seng Tech, and the HSCI, all up by 0.5%, trading near the session high. So the reason why the Hang Seng stock indices are up right now is due to a positive news, positive economic data from Tier 1 Chinese data. Industrial production year-on-year on the average for January and February came in better than expected, annualized both months, 6.3% year-on-year for both months on the average, above consensus of 5.1% and also above the previous December print of 5.2%. And also retail sales on the average year-on-year for both months, January and February, also rose higher than expected, 2.8% year-on-year, above expectation or consensus forecast of 2.5%, and also above the previous miserable December print of 0.9%. So because of this, industrial production and retail sales managed to beat expectation and managed to beat the rose above the December print figures. That created a positive feedback loop into the Hang Seng indices as we are speaking right now. And over to the rest of the other Asia, most of them are in the red. The ASX 200 is down by 0.5%, trading near the session low. The Kospi almost unchanged, negative 0.09%. So that's the South Korea benchmark stock index, and our Singapore STI is almost unchanged at 0.03%. So more like a mixed bag performance that's being seen on the major Asia Pacific stock market as we're speaking right now. And over here, one thing I will quickly share you guys is the heat map of the S&P 500. So this was the heat map of S&P 500 last Friday. So we see a sea of red in the technology stocks. But what's interesting over here is that let me take you through the groups, the breakdown of the 11 sector. So we know that consumer, defensive, and energy and utilities continues to outperform almost every day last week. So if you look at by the end of last week performance, we start to see the strongest being the energy sector, which is US energy stocks, like with the likes of Chevron, ExxonMobil. And as a whole, the entire energy sector is up by 2.26%. So bear in mind that the energy sector within the S&P 500 is only a very, very small weightage over here. So despite this positive gain in energy stocks, they are not able to, we call it succumb or overcome the heavy weightage technology and consumer discretionary, and as well as some form of financials that could allow the S&P 500 to close in the green for last week. So the other two outperforming sector will be utilities, which is considered as a defensive sector as well, up marginally 0.23%, and consumer staples / defensive down marginally 0.17%. Okay, down negative 0.17%, negative 0.17. All right. So very quickly, now let us take you through the individual technical intraday trend bias and key levels to watch for today. So before I do that, let me expand my screen. All right, over here, so that you guys could have a better view of the charts. Yeah. So let us start with the FX market. Okay. So FX market, the euro dollar. So euro dollar last Friday, we have a bearish bias, and the bearish bias has almost already hit the 2 support level and now coming close to the second support level at the 114 figure for those who follow our daily dose on a frequent basis. So it printed a low at on the closing hour of the US session on last Friday, which is Singapore time, Saturday, 14th of March, 4 a.m. 114.1111, all right, 1.141111, which is very close to our pivotals, our second support level, which is 114 figure. So, and what's interesting over here is that the hourly RSI has starts to shape a bullish divergence as well. And right now it has really exited the oversold level and also did a bullish breakout above its former key descending trend line resistance that was previously in place since 10th of March this year. So this observation that I explained in RSI indicating that the downside momentum that was seen on last Friday has already eradicated or subsided, put in a way where we could see a possibility of a minor mean reversion rebound over here for the euro dollar. So using 114 figure level, short-term pivotal support for today, I will flip to a bullish bias for this potential intraday mean reversion rebound on the euro dollar. Two resistance level to watch will be 115.09 followed by 115.65 for today. Above 115.65 may expose 116.05 next, which is the congestion area of 11th of March and 11th of March in the Asia session and on the US session at that point in time. Only a bearish breakdown and an hourly close below 114 figure short-term pivotal support that would invalidate today's intraday mean reversion rebound scenario to see the weakness continue to expose the next intermediate support in first step at 113.60 followed by 113.13. So those are Fibo extension level for 113.13, and as well as if you look back graphically, that is the congestion area of 2nd of June and 4th of June last year, and the lower one at 113.13 also confluence with the minor swing low of 30th of May last year. All right, so that's for the euro dollar. Flipping to a potential intraday mean reversion rebound scenario using 114 figure level as the short-term pivotal support. Next up will be the sterling dollar over here. So the sterling dollar hit our support level, the second support level, and stage a bounce. And what we could see is that before staging a bounce, the hourly RSI shaped a bullish divergence, all right, on last Friday, where it shaped a lower low, all right. And right now at the Asia session, as you're speaking right now, 11:24 a.m. Singapore time, it did a bullish breakout from a key descending trendline resistance that has been in place since 10th of March over here. So with such positive observation on the hourly RSI, also very similar for the one that is being seen earlier on the euro dollar, indicating that last Friday downside momentum most likely has been eradicated. So potential higher chance of a minor intraday mean reversion rebound in the first step for today. So what I will do is I will flip to a bullish bias for this potential mean reversion rebound scenario on the intraday basis to unfold using 132.20 as my short-term pivotal support level. Two resistance level to watch, 132.83 followed by 133.40. Breaking above 133.40 will immediately see the key short-term resistance coming in at 134 figure level, psychological level, congestion area of 11th of March, 12th of March, and as well as this upper limit of this medium-term descending channel that has been in play since the high of 28th of January this year. Only a bearish breakdown and an hourly close below 132.20 short-term pivotal support for today that would invalidate the minor intraday mean reversion rebound scenario to expose further weakness towards the next intermediate support level at 131.80 followed by 131.55, 131.25, which is the 1.618 Fibo extension of this ongoing medium-term corrective decline in place since 28th of January this year, and the 131.25 also confluence with the swing low of 26th of November this last year. Right, so that's for the sterling dollar. Also flipping to a bullish bias for today for a potential minor mean reversion rebound using 1.220 as the short-term pivotal support level. Next will be the Asia Pacific major dollar pair, starting with the Aussie dollar. All right, give me a couple of seconds. Right, so the Aussie dollar last Friday, we have a bearish bias. The bearish bias hit our support level at this 70, this level here. which is 69.95 level, 69.95 level before staging a bounce. And what we could see now is that it also shaped a bullish divergence as well as being seen. And it's now coming very close to the 50-day moving average at around the 69.44 level, which is the minor swing low of 3rd of March. So with that, I also flip to a intraday bullish bias for a potential minor mean reversion scenario to take place first in the first step using 69.44 as the short-term pivotal support for today. 2 key resistance level to watch will be 70.75 followed by 71.20/71.40, which is the congestion area of 11th of March and 12th of March over here. And if you do the Fibo retracement of this last leg of the recent leg of sell-off from 11th of March all the way down to last Friday low, that consists of the 76.4% Fibo retracement level. All right. However, a bearish breakdown below 6944 will see a further dip to challenge the 6910 medium-term pivotal support level. All right, so that's for the Aussie dollar. Next will be the dollar yen over here. So the dollar yen continues to remain pretty strong. So yet last Friday it broke above 69.45, 159.45. So if you look at the daily chart over here, okay, it kind of cleared above this 159.45 medium-term pivotal resistance level. So this is also the high that is being seen on Wednesday, 14th of January, and this 159.45 was also the previous intervention level where BOJ under the instruction of the Ministry of Finance sold US dollar and buy back the yen at a point in time on 12th of January 2024 over here, 2024, right, which is the high at 159.45. And at the point in time, hitting the 159.45, that also created a bit of fear that the BOJ might step in, where the Bank of Japan, together with this US Treasury Department, conducted rate checks in the banking in various US and Japanese bank, creating the fear of joint intervention. So, however, on last Friday, it did a daily close above that level at 159.45. So, i.e., which means that now there could be a chance for further potential push up, perhaps back towards the long-term pivotal resistance level at 161.95. That is also another level where the Bank of Japan intervened in the FX market, where it created that sharp sell-off from 3rd of July all the way down to 16th of September 2024, dropped by close to 30 big figure. I would say that close to about 30 big figure from 161 to not 30, around 25 big figure, 161.95 to a low of 139.58 over here. So that's the dollar yen daily chart. So since it's have a daily close above 159.45, so on a very short-term basis, I will flip to a very bullish bias, pardon me. So on a very short-term basis, I will flip to a bullish bias on the dollar yen, given its daily close above the 159.45 level. So with that, I will have a pivotal support level on last Thursday minor swing low that also confluence with this running minor ascending channel support that has been in place since the low of 17th of February this year. So that will be confluencing at 158.60. So using 158.60, 158.60 as my short-term pivotal support level, flip to a intraday bullish bias on the dollar yen. 2 resistance level to watch in the first step, 160.23, followed by 160.74, which is the upper limit of this minor ascending channel. Only a bearish breakdown below 158.60 that would invalidate today's bullish bias move to see a minor corrective pullback to expose 158 figure level, followed by 157.40, which is the minor swing low area of 10th of March, 11th of March, and as well as 6th of March. So that's for the dollar yen. All right, so that sum up all the intraday technical outlook on the 4 major US dollar pair. Let us now discuss the major stock indices over here, starting with the Hong Kong 33. So the Hong Kong 33 managed to bounce from our neutrality zone lower limit that we have on last Friday 25,385. So given that it's already coming to the top of the range, the upper limit of the neutrality range again, so I would remain neutral between 25,887 and 25,385 for now, unless we see a breakout and the hourly close above 25,887, then potentially price action may see a further push up today to retest the 11 of March minus swing high area at 26,147, and that also confluence with the downward sloping 20-day moving average as well. So that's for the Hong Kong 33 representing the Hang Seng Index. Next will be the Japan 225 representing the Nikkei 225. So the Nikkei 225 or the Japan 225 continues to trade continue to hold at the lower limit of this pivotal support, which is the sideways range, which is the zone of 53,616. The lower limit will be at 53,066 over here. So let me use the lower limit instead. Okay, so this was Thursday pivotal support level, but on Friday, due to this rather very mixed picture on the market, so on the what I call it, the Nikkei, the Japan 225, so we flip to a neutrality stance instead. All right, so with that, the RSI continues to be held above this ascending trend line support. So I will still maintain my neutrality stance for now. So still maintain this between 53,066 and 54,900, which is also the 50-day moving average that has been capping the Japan 225 from going higher since last Wednesday, 11th of March. So neutral between 54,900 and 53,066. If we start to see a bearish breakdown below 53,066, then potentially further weakness may unfold to retest the swing low that was seen on last Monday, 9th of March at 51,055. So that's for the Japan 225. Next will be the Germany 30. So the Germany 30 also continues to trade in a sideways range between our short-term pivotal support and the upper limit of the range will be at 23,805. So still no change. If you look at it, the hourly RSI continues to be held by this parallel ascending trendline support. So we will maintain a neutrality stance for now, neutral between 23,805 and 23,220. 23,068. Only a breakout above 23,805 and the hourly close above it may see a retest at the next intermediate resistance area, which is the 200-day moving average and the minor swing high of 5th of March at 24,162 slash 350. All right, over here. So that's for the Germany 30. Next will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 almost came down and hit our support level that we have a bearish bias on last Friday, which is very close to our long-term pivotal support at 46,330, which is also very close to the key 200-day moving average. And what's interesting over here is that the hourly RSI has started to shape up a bullish divergence as price action hit lower low, but it's flash out a series of higher low instead. So this higher low that is coming into play, and where the RSI, where the price action managed to survive right exactly at our long-term pivotal support, there could be a chance or an increased possibility that we may see a mean reversion rebound, a minor one, coming into play for the US Wall Street 30. So with that, we will flip to an intraday bullish bias for this potential minor mean reversion rebound using 46,330 as the pivotal support. Two resistance level to watch: 47,214 followed by 47,460, which is also the upper limit of this minor descending channel that has been in place since 26th of February. Only a bearish breakdown below 46,330 that would expose the next intermediate support level, 45,780. Followed by 45,485, which is the lower limit of this minor descending channel. Right, that's for the US Wall Street 30. S&P 500. So the S&P 500 also tumbled in our last Friday bearish bias view, hitting our support level, which is also the 200-day moving average at 6,610, 6,585. So using 6,610, 6,585 as my short-term pivotal support level, in line with also the bullish divergence that's being flashed out on the hourly RSI, we will potentially we will flip for a potential intraday mean, we'll flip to a bullish stance for a potential intraday minor mean reversion rebound scenario that may unfold towards the next resistance zone at 6,755, 6,755, 6,775. Above 6,775, potentially see a further squeeze up towards 6,815, which confluence with very closely with the 20-day moving average as well. However, a breakdown below 6,585 that would invalidate the minor mean reversion rebound scenario to see the impulsive downward sequence extending further towards the downside to expose the next near-term support level 6,535, 6,500. Below it, see 6,420 next, which is the 2-time Fibonacci extension of this ongoing corrective decline since its all-time high on 28th of January this year, and also the congestion area of 3rd of September and 4th of September. Right, so that was last year. So this is the S&P 500 flipping to a intraday bullish bias using 6,610, 6,585 for a potential minor mean reversion rebound. Next will be the Nasdaq 100, also very similar price action movement that's being seen as well versus the S&P 500. So we also start to see a bullish divergence that's being played out on the hourly RSI. The Nasdaq 100 declined as expected on last Friday, where we have a bearish bias hitting our support level, which is the 200-day moving average, and also this area over here as well, which is the congestion area of 9th of March. So with that, I will flip to a bullish bias for today for a potential minor mean reversion rebound scenario using 24,350/24,280, which confluence with the 200-day moving average. So this will be my short-term pivotal support zone. 2 key resistance level to watch for today: a potential mean reversion scenario, minor mean reversion scenario, 24,787, which was last Friday US session high before the tumbled took shape, and as well as 24,910, which confluence very closely with the 20-day moving average, and also this descending trend line resistance that has been in place since 28th of January this year. Only a bearish breakdown below 24,280 that would invalidate today's bullish bias view for that mean reversion rebound and kickstart another leg of weakness to expose to 24,140, followed by 23,955, 23,840, which is the low of 24th of November and the swing low area of 21st of November. Right, so that's for the Nasdaq 100. Next will be the commodities market, starting with the gold XAU/USD. So gold last Friday tumbled from our range support level that was previously in place since 3rd of March. So that's 5,045. It broke below this level and it hit our next support level, which is the rising 50-day moving average, very closely at 4,960. So that is the intraday low on last Friday was 4,997. So using 4,960 as the lower limit of this support level to watch, we flip to a neutrality stance first for now. Lower limit of this neutrality zone 4,960. Upper limit will be last Friday high, which is at 5,125, which also confluence with the 20-day moving average that has been taken down since last Thursday US session. So flip to a neutrality stance for now between 5,125 and 4,960 for gold XAU/USD. Lastly will be the West Texas crude oil over here. So the West Texas crude oil continues to push up and is now coming very close to our resistance level that we have on last week, potential bullish bias 102.25. And also interestingly, the RSI seems to have formed a resistance level at around the 67.43, indicating that the momentum has upside momentum has started to slow down. And from a Elliott wave perspective, this is also seems to have a 5-wave up sequence as well. Put it in a way that I may put it in writing for you guys to take a better view of it. So this is a minor 5-wave bullish sequence that has already been completed, starting from the low of 11th of March. Okay, this is wave 1. minor wave 2 over here. Then it's 1, 2, 3, 4, 5. Minor wave 5, wave 3. Then you have the minor wave 4, which was the low on last Friday, 8 p.m. Singapore time, 13th of March. And right now we are in the progress of shaping that wave, minor wave 5 towards 102.25 over here. And the wave 1, wave 2, wave 3, then to seek out the wave 5, minor wave 5 potential upside target, we do a Fibo extensions, taking from the start of the minor wave 1, which is the low of last Wednesday, project it towards the end of wave 3, and take it from the low, the length is the length of wave 1 to wave 3, and project it to the low of wave 4, which is on last Friday, and we are able to potentially seek out the minor wave 5 terminal level, or the end of the wave 5, which is typically at 0.618 Fibo extension, or 0.382, which is this morning session, Asia session high, very close at 101.19 over here. So which is very close to the graphical resistance of 102.25. So with that, I'll be using this 102.25 maximum 105.85, which is the 0.618 Fibo extension, to fade this rally. That means potentially there could be a minor setback to retrace this 5-wave up sequence. All right, over here, the one minor 5-wave up for a potential, we call it a reset or a consolidation before the bulls starts to take shape again on the West Texas oil, being reinforced by this hourly RSI being kept by a resistance level at 67.43, indicating that upside momentum has started to dwindle off as well. So with that, I'll be using 105.85 short-term pivotal resistance level to fade the strength for a potential minor setback scenario to take shape, for it to consolidate first before at the new leg. So consolidation support level to watch 92.60, the wave low of the minor wave 4, maximum 88.36, which confluence with the rising trendline support that has been in play, the minor ascending trendline support that has been in place since 26th of February low, and also the former minor swing high of 11th of March that now turns into a pullback support level. Only a sudden push up above 105.85 that would invalidate today's intraday bearish minor setback view and see the continuation of the bullish impulsive up move to retest the previous last Monday minor swing high area at 116.56/119.54. All right, so that's for West Texas oil. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? All right, so today during the European session, it will be rather quiet and nothing much. So for those who have interest in the dollar CAD or the Canada dollar crosses, key inflation data out for Canada will be out at 8:30 p.m. Singapore time, where market participants will be paying close attention to the core inflation rate over here. So previously, the core inflation rate for January was at 2.6% year on year. So this time around, Trading Economics is forecasting a slight dip to 2.4% year on year for the month of February, below previous January print of 2.6%. So heading into the US session, not much important key tier 1 data to take note of as well. Right, so that potentially that sums up today's daily dose of market insight. So other than this key data to take note, the next thing to look out for will be this ever fluid changing news flow coming out from the US-Iran conflict that is now entering its 17th day. So with that, I'm Kelvin here signing off. I wish you guys a great day ahead, and do practice proper risk management due to this ongoing fluid situation in the Middle East, which pretty much being centered on the US-Iran war/conflict. So take care, and we shall speak again tomorrow. Thank you.